My name's Ethan Braid. Today we're going to talk about the likelihood of a soft landing for the economy in 2024 or 2025. Soft landings are very rare. There has been only one soft landing in the last 7 decades. They don't happen very often. But I'm going to show you a simple and effective way to gauge the probability of a soft landing occurring for the economy in 2024 or 2025. Much like the year 2000 and 2008, there is a lot of talk about a soft landing, and many investors are betting heavily that we're going to have a soft landing for the economy. So let's take a deeper look at the history of soft landings and the likelihood that we may have a soft landing in 2024 or 2025. This chart shows us the track record for the Federal Reserve Bank at engineering soft landings. Their track record is terrible. This is the last 70 years of the effective federal funds rate. This is the interest rate that the Federal Reserve Bank controls. And what you can clearly see is that there have been 10 recessions in the last 70 years. Recessions are the gray bands on this chart. And you can see right away that interest rates start going up and up and up, and then we get a recession. Then the Fed reacts and drops the rates down. Then they start bringing rates back up, and we get a recession. Long-term cycle of raising interest rates, something breaks, we get a recession. Rates are going up, we get a recession. Rates are going way up in the late 70s, early 80s, and we get 2 recessions. Here we are in the 90s, rates are going up, we get a recession. Here's the soft landing, folks. This is the early to mid 1990s where the Fed raised rates right here, and you don't see a gray band. There was no recession. So this is the only soft landing that happened in the last 7 decades. Since the soft landing of the mid-1990s, we've had 3 more recessions. We had the recession of 2000, where you see rates are going up, and then we get recession. And then the 2008 recession, rates are going up, the recession. And finally, ironically, the government-induced recession of 2020 that was preceded by what? Rising interest rates. So here we are now in 2024, rates have been brought up dramatically, and we don't have a recession yet. When you look at this chart and you see only one soft landing out of 11 interest rate increase cycles and 10 recessions, that should tell you that your odds of a soft landing are very low, 10% or less, in my opinion. So the takeaway is pretty clear. The Fed raises interest rates to slow the economy down, and most of the time they cause a recession by restricting credit too much. Here's an analogy to think about the economy and the Fed, how they interact with one another, and why the Fed generally doesn't get it right with respect to a soft landing. Compare the economy to a freight train, 3-mile-long freight train moving at 50 miles an hour. If you want to slow that train down, you cannot do it in 10 feet without causing a serious accident. You need a long amount of rail space to slow that train down. So when the Fed raises interest rates, the economy, i.e. the train, is moving very quickly. It takes a while to slow it down, much like the interest rate policy takes a while to become visible in the economy and start moving the unemployment rate up and slowing construction down. The problem is that the Fed almost always raises rates too much. It's because there's a lag between when those rate decisions become visible in the economy and when they make the rate decisions, say 8 months to a year. It's very difficult to gauge, have we raised interest rates enough? And conversely, have we lowered interest rates enough? Therefore, raising and lowering interest rates is just a guess by Jerome Powell and his team. They have the same data that everyone else has available to them, and they're just guessing, right? And their history of guessing has been pretty poor. So, as we move forward, Think about your investments and where we're at in the investment landscape. Much like the year 2000 that I recall distinctly, where people were betting on a soft landing, or in 2008, same situation, people were getting excited about a soft landing. Well, it didn't happen. So when it comes to managing your money today, think about this. Many people are betting heavily on the most unlikely outcome. Is that a good way to manage your money? I say no, right? You want to think about the likelihood of a soft landing in the context of your portfolio. Many people want to gamble on this, and I struggle with it. I've seen it twice before, and I feel like it's deja vu. It's 2000 and 2008 all over again, where people are amped up for a soft landing and making heavy bets that a soft landing is going to happen, but you're betting on the long shot. So consider that, again, in the context of making decisions for your portfolio and your investments. Why would you want to bet on the long shot? And also, we have an inverted yield curve. It's been inverted for quite some time, and people are brushing that off. But the inverted yield curve is a very effective predictor of a recession. Typically, the yield curve inverts about a year before the recession shows up. This time, we're inverted for almost 2 years. But remember that the yield curve inverted in 2006, and it was 2 years later in 2008 that the recession showed up. So we're not out of the woods yet, in my opinion. But let's take a look at some things that the Fed has done in recent years that I think are complicating our economy. This chart shows the mortgage-backed securities held by the Fed. Prior to 2008, the Fed did not hold any mortgage-backed securities, but as a result of the 2008 recession, the Fed decided to buy $1 trillion of mortgage-backed securities. When the COVID pandemic struck, the Fed decided to use the same playbook, and so from 2020 to 2022, the Fed went and purchased $1.4 trillion of mortgage-backed securities. In this case, they overstimulated and helped create the housing inflation that they are now trying to get under control. Since 2022, the Fed has been slowly, at a measured pace, winding down their mortgage-backed securities holdings. In addition to mortgage-backed securities, the Fed also purchased $3 trillion of long-term treasuries from 2020 to 2022. And like mortgage-backed securities, the Fed is slowly, at a measured pace, reducing the long-term treasury holdings. The impact of the Fed actions is clearly visible in the M2 money supply. Starting in 2020, we see an explosion of the money supply, and it should not be a surprise to anyone that we then had significant inflation. The Fed caused the inflation by just putting too much money out there. What is very interesting is the contraction of the money supply afterwards. Typically, you would expect an immediate recession or even a depression like we had in the 1930s when the M2 money supply really starts to contract like it did in recent years. But because things have become so complicated and the numbers have become so large, nothing has happened yet. And finally, we have the most inverted yield curve that anyone has seen in over 60 years. An inverted yield curve has preceded each of the last 8 recessions for over 6 decades. So to sum it all up, the odds of a soft landing are very low. However, we're in the midst of an economic experiment. The Fed has injected trillions of dollars of liquidity into our financial system, and now they're slowly trying to take it out. At the same time, the government has provided unprecedented monetary stimulus. We're running a deficit. We're spending tremendous amounts of money. So we don't know how this is all going to play out. And for those reasons, I think it is a little aggressive to be betting on a soft landing when you know that the odds of a soft landing are very low. You probably don't want to do that with your retirement portfolio if you're retired or getting close to retirement. Not prudent, in my opinion. Hey, let's hope we get a soft landing. That would be fantastic. But let's be realistic about whether or not a soft landing can happen. I hope this video was helpful. I hope it gets you thinking, helps you better analyze your investments, and overall improve your family's financial plan.